This session begins learning module number 4, dealing with adjusting entries, both accruals and deferrals, and ending with the closing process. So let's begin. Okay, so up to this point, you have posted transactions into T accounts, and you have them balances in those accounts. What we do know is that there's always, based on timing differences, entries that have not been taken care of. So either the balances that you currently have aren't correct, they need to be adjusted, or you have entries that have not been put on the books yet. And so we have two types of entries, accruals and deferrals. The reason that we have to do adjustments is because we want to get the books to the best balance that we are aware of. And so that will take some additional manipulation on our part to get those balances to be the most accurate. We also have two types of accounting that's possible. One is called the cash basis of accounting. And what that stands for is that the cash in and the cash out is what you record on your financial statements. And so that would mean that you have to receive all the money and spend all the money to be able to report either revenue or expenses. And we call that cash basis of accounting. Most of us are on the cash basis of accounting. The other type of accounting that we have is what we call the accrual basis accounting, where we want to match revenues when earned with expenses when incurred. And that is the method in which adheres to GAAP. And so that is the accounting method that we use. We do not use the cash basis because it doesn't adhere to GAAP. And so let's go ahead and take a look at the 4 types of adjusting entries. And then there are five or six adjusting entries. And I'm going to provide you a template using just debit and credits and X's. And then when you come to class, we will in fact plug numbers in here to further explain it. But what I want you to do prior to coming to class is be aware of the 6 entries, what they look like in a template, and then we'll fill in numbers for further understanding once we gather. Okay? So the first thing that we want to talk about are the 4 types of entries. So we have something that's called deferred revenue. Okay? Deferred revenue. And that is simply that cash is recorded prior to earning revenue. Okay? So we've had an example of all already that where somebody gave us a deposit or somebody gave us money and we put that, remember we debited cash and credited unearned revenue. That is in fact an example of unearned revenue. That is the original entry. And that is when somebody gives you money prior to you earning the revenue. You got to keep it in an account. And remember that this revenue account or unearned revenue account is in fact a liability. Because if we don't perform the service, then we'll have to give the money back. All right? So then what we also have, if we're sticking with deferrals, is we have deferred expenses. Okay? Deferred expenses. And this represents cash paid prior to the expense being due. Prior to the expense being due or used up or used up. I think that's the best way to put it. Okay? Then we have what we call accruals. Okay? We have accrued revenue. And accrued revenue is cash is received after the service is provided, okay, or after the revenue is earned. Let's use those words. Okay. And then we have accrued expenses. And this is cash is paid after expense is created. So, or incurred, I believe is the word they use, incurred. Right? So what are 4 just brief examples of these? And I'll get into more detail here in a minute. So one is deferred revenue. We talked about that. The original entry would be a debit to cash and a credit to unearned revenue. In other words, a customer has deemed it necessary to give you money up front before you perform any of the services, so before you earn the revenue. On a deferred expense, sometimes it's necessary for us to prepay the expense. For instance, a 24-month insurance policy. What we would do there is we would debit prepaid insurance and credit cash. But we don't want to record the expense until we use up the insurance. So after each month passes in the 24-month period, we will then move from prepaid to insurance expense. And that's what we're going to be doing in the adjusting process, is adjusting these accounts for either what we've earned or what we've used up. Down in accruals, it's a little bit different in the fact that an accrued revenue is we're going to receive the cash after we've earned the revenue. So you guys have already been doing that when we've billed customers or if you complete a service. And that entry is always been a debit to accounts receivable and a credit to service revenue. So we don't have that earnings on the books yet, and we have to put them on. The same thing goes with an expense. For instance, if somebody earns salaries, but we don't pay them till later, like after the month ends, then we have to go ahead and put those on as a payable, showing the expense to match the revenue it helped us earn, but paying it much later. And so that is kind of the definition of an accrual. What you need to understand is for every adjusting entry, you are going to affect one balance sheet account and one income statement account. Okay? Also, in deferred revenue, cash has changed hands. So for deferrals, cash has changed hands, and there's an original entry already on the books. An original entry on the books already. All right. For accruals, nothing's on the books. You will be making an original entry. Okay? You will be making an original entry. So let's go and take a look at the 6 types of adjusting entries. So we're going to start with accruals first. Accrued revenue. So when you have to accrue revenue, the journal entry will look like this every time. Okay? Doesn't matter about the numbers yet. We'll deal with the numbers here when we gather. But right now we just want to take a look at is what this template looks like and which of these 6 adjusting entries you will use and when. And so the first, for accrued revenue, you're always going to go either to accounts receivable, okay, and that will always be your debit entry. Okay? You also could go to interest receivable if somebody owed you interest. I'm just giving you a couple of possibilities, and you would debit that. The credit will always go, so for accounts receivable, the credit will go to service revenue or some sort of revenue account, and that's your credit. Okay? That is the only entries that you would typically make for accrued revenue. Okay? You're either going to debit accounts receivable or debit interest receivable. If you do interest, then you would also go to interest income or interest earned. Okay? So that is for accrued revenues. For accrued expenses, you're always going to debit the expense account, whatever that might be. If it's utility expense, if it's auto, whatever expense that you're putting it on, you would debit the expense account. And then you're going to credit accounts payable, because we're going to increase accounts payable. This gets both revenue and expenses on the books ready to go to give us the most accurate financial statements. All right? So those are only two types of accrual adjusting entries. Now, the third entry is kind of a hybrid entry. It's technically a deferral, but I'm going to give it to you here. And this entry needs to be done like this, just like this. In Chapter 8, we're going to learn how to come up with the numbers. But right now, till we get to Chapter 8, the book is just going to say, hey, we have depreciation of $5,000. And so the adjusting journal entry for depreciation is a debit to an account called depreciation expense and a credit to an account called accumulated depreciation. And that gets a credit. Okay? And this is simply to record depreciation. It's not on the books, and you need to put on. So a brief explanation of what depreciation is. It's when you slowly expense, like buildings, furniture and fixtures, and equipment, slowly over time. Remember, we are governed by the matching principle, which says you want to match revenues with the expenses when they are incurred. So if I buy a $100,000 piece of equipment, that equipment is going to benefit me far past the month that I'm buying the equipment. So therefore, we've come up with depreciation to slowly expense that equipment over time. And we use that by doing this adjusting journal entry. Now, we have this new account, which is called accumulated depreciation, and it is a contra asset account. Okay? And that's because this goes on the balance sheet under equipment. Okay? Goes on the balance sheet. It's a contra asset because to increase this account, you use the credit side. So by doing this entry, I'm increasing this accumulated depreciation account. Therefore, we call it a contra asset because it's contrary to what all assets are. To increase all assets, your memory banks will tell you, hey, I use a debit to increase all assets. So therefore, this is a contra asset account. And it is shown, and that's because it's a credit entry to increase it. So when I show it on my balance sheet, I'm going to show my equipment, whatever that dollar amount is, less the accumulated depreciation account. So that's a minus. And I end up with net equipment. Or sometimes we use the word net book value. So this is what the presentation would be on the balance sheet now that we've added this new contra asset account. So now let's go ahead and take a look at the deferrals and what those entries will look like in a template. Okay, let's go ahead and move on and let's talk about the deferrals. So there are 2 deferral entries, possibly 3, but really 2, but we can cover a lot under the particular deferrals. So if we have the first one, which is deferred revenue, okay, that's the one that you guys have already done, where you've taken in the cash and then you've credited unearned revenue. So at some point, we have to recognize that revenue that you've put as a liability because we've earned it. And so that particular journal entry will always look like this. You will debit unearned revenue, and you'll credit earned revenue. So basically, all you're doing is moving the amount that you've earned to earned revenue. So out of the liability, so that means if we don't perform, we now get to keep that. Now that we've performed, we get to keep the money. Any balance that's left in that account, we still have the opportunity to have to give it back if we don't perform. But in this case, we're moving that amount of the revenue that we've earned. And so the journal entry, the adjusting journal entry will always look like this. For deferred expenses, there's several categories that come under deferred expenses. And this is how we would look at each one of these individually. So if we have supplies, we are now going to debit supplies expense, and we're going to use up the amount of supplies that we used are going to be moved from the supplies, the asset account. So all we're doing is taking the amount that we've used and moving it to expenses. It's no longer an asset because it no longer exists. So that's one deferred expense. The other one would be we would go to rent expense. Okay. We would go to rent expense and we would credit prepaid rent, because now we've used up the rent. The month has happened and now they can take it out of our account and go ahead and put it into expense. And the other one that we talk about in adjusting entries is insurance expense. And that would be credited against the asset prepaid insurance, because now we've used up that month of insurance. So like if you pay your auto insurance a year at a time, every month that goes by, if you were to leave that company, they wouldn't owe you a refund. They would only owe you a refund for the months you haven't used yet. So these are all examples of deferred expenses and adjustments that potentially you would need to do in your adjusting entries before you can prepare the financial statements. So as you can see, there are 5 major adjusting entries, one for accrued revenue, one for accrued expenses, one for depreciation expense, and then these 2 for deferred revenue and deferred expenses. Every adjusting entry you'll do will look like these, both what I just showed you previously and what I show you now. Now the trick is to figure out what are the numbers that are going to go in there and how do we figure those out. And that's what we're going to leave for class, is to go ahead and now apply numbers to these templates.